have two conflicting things here. The markets or interest rates like Fed rate hikes, but they hate balance sheet runoff. And I think it's important to just share this chart with you because I think this really illustrates it well. I have this pulled up here on TradingView, and what you can see here as this loads up here is all of these vertical lines here will show you when the Fed has go ahead and hiked rates, as well as when they've increased the runoff of their balance sheet. So we're actually going to go back to the last Fed rate hike cycle. So this was back in 2015 in December. Now you can see the 10-year was trading right around 2.3%. The Fed went and hiked the Fed funds rate by 25 basis points. And then what happened after that? You can see 10-year yields moved sharply lower. They moved down to about 1.3% at the low here. So you saw a full percentage point decline after the Fed hiked the Fed funds rate. Why? Because they curbed inflation. But then they waited a full year until the next Fed rate hike. So what happened during that time period? The economy can heat up, inflation can increase, and you saw rates move back up. But then guess what? In December 14th of 2016, they hiked rates again, and you could see they hiked it a few times, and then look what happened. Yields started to go down. But then October of 2017, the Fed announces balance sheet runoff. And you can see what happened. Once the Fed started allowing for runoff, yields started to move higher again. And they did this in increments. So they first allowed 10 billion to run off, then 20 billion, then 30 billion, then 40. And then at the peak, they allowed for 50 billion a month of runoff. And then guess what? In May of 2019, they said, you know what we're going to do? We're going to slow the runoff. And you saw yields move lower. And then in July of 2019, they stopped the runoff altogether. And they actually started to reinvest 20 billion a month in mortgage bonds and treasuries. And of course, you can see what happened where yields moved much, much, much lower. So the important thing to note here, as you can easily see on this chart, is you actually can see yields improve or move lower, or mortgage rates move lower when the Fed hikes, but when they allow for runoff, you can see those rates go back up. So these are key themes to watch for. And listen, the Fed, I don't envy them because they have a tough job. You know, they say that their two mandates are stable prices. Well, obviously they missed on that one. We have 7% inflation and maximum employment. And we got the jobs report this week, and this was a really strong jobs report, much better than expectations, some really big revisions. So we're pretty close on the maximum employment.